Intercorporate investments. Can you tell me what does it mean? One company investing into another company. So let us say we have a large company A which is going to buy shares of a smaller company B. Now there could be different reasons why A is willing to buy shares of B. One reason could be that A is in possession of some excess cash. It wants to temporarily invest that cash into shares of company B and then wait for good opportunity to exit and make some profit out of it. Or other reason could be that A intends to buy 20-30% shares of company B and slowly start influencing the business model of company B. Or A intends to buy 50-60% stake in company B and eventually take control of the operations, isn't it? So depending on what is my intention of that investment, the accounting treatment will be different. This topic we will be dividing into three categories. First, so think of it this way, that this company A is Reliance Industries and company B is L&T. Okay, L&T is not so small, so maybe B. Now Reliance Industry has purchased some 10,000 shares of L&T or 1 lakh shares of L&T. That means their ownership of L&T is less than 1% or less than 2%, 5%. So typically when your stake in other company is less than 20%, we call that we have made investment in financial assets. And once we have decided to classify this as financial assets, then we've also learned this at level 1, that further these could be categorized into or divided into three categories. First one is HTM, which is held to maturity. Second one is AFS, and third one is trading securities. AFS is available for sale. So depending again on how long I intend to hold those securities, we will decide whether those should be HTM, AFS or trading. But how about a scenario that your investment is actually more than 20%? Let us say you have invested 21% or 30% or 40%. That means it is more than 20% but less than 50. Now in this category, you will start having some influence on the business model of the company. So if it is in this category, we would say this is investment in associates. And method of accounting which is recommended for investment of associates is equity method. But how about a scenario where your stake exceeds 50%? Now in this case, you will have control over the company. That means that company now becomes your subsidiary. And if it is a subsidiary, then the method that we would be using for accounting of this subsidiary would be consolidation. So roughly this is the broad structure of the topic. We have to understand how to do accounting for the equity method, how to do accounting for consolidation. In fact, there is one more, a scenario of joint ventures. In case if there is joint venture between two organizations, again the recommended method in both IFRS and US GAAP is the equity method of accounting. Okay, so quickly write down this part. Now let us learn to deal with the investment in financial assets. HTM, AFS and trading security. On balance sheet, HTM held to maturity is shown at amortized cost, okay, which is different from historic value. On AFS, on balance sheet is shown at fair value. Trading security on balance sheet is shown at fair value. On income statement, in case of HTM, we show realized gain. In case of AFS, realized gains. And in case of trading security, realized plus unrealized gains. And then in OCI, we don't have to show anything here, neither do we show anything here. But in case of AFS, we show the unrealized gains. Okay, so write down. We'll do an example on each one of them. Done writing? Now let us see how does the amortized cost function work. We'll do two examples. Example number 1. Let us say face value is 1000. Coupon rate is 0%, which means it's a zero coupon bond. Let us say YTM is 17% and maturity is 15 years. You purchased it at time 0. It has been classified as HTM. Find out what amount should we show on balance sheet, how much should we show on income statement, and how much should go on OCI. YTM on year 1 is 19, sorry, not 19. This is 15%. YTM at the end of year 1. 111. On balance sheet? Alright, let's do it together. Let's find out at what price did we purchase this bond. Second clear TVM, 1000 future value, 17 IY, 15 N, compute present value. Huh? 94.88. So the price at which we purchase the bond is 94.88. Now just make 14 as N, keep the IY same. 111.01. Now make 15 as IY, keep 14 as N. 144.3. Now 141.3 is the current market value of this bond. And on balance sheet we do not show it at fair value, we show it at amortized cost, which means for us this is an irrelevant information. In case of HTM security, we don't need this. So on balance sheet we will show it at 111.01. And this is the meaning of amortized cost. And on income statement we show realized gain. Is there a realized gain? Are you receiving anything in this year? So is there a realized gain? Yes, there is. You haven't received in cash, but you have earned. Realized doesn't mean you have to receive in cash. So the difference of these two amounts, 111.01 minus 94.88, 13. This is the amount you would show on the income statement. And of course in OCI we do not show anything. So this is 0. Are we fine here? Example number 2. Face value 1000. Coupon rate 10%. YTM 15%. Maturity 6 years. This is again classified as HTM. At the end of year 1, YTM is 12%. Find out at what price we should show it on balance sheet, on income statement, and of course we know now that there is going to be nothing on OCI. Yes, what is the price at which we purchased the bond? 810.77. Now using again we know that this is a irrelevant information because we are not concerned about market prices. So what should be the price of the bond at the end of year 1? 8.39. So on balance sheet we will show the amortized cost of 832.39. On income statement, how much is the realized gain? The coupon of 100 which we have received plus the difference of these two, 832.39 minus 810.77, whatever is the difference, 21.62. So total realized gain, though not received in cash. So we have realized 100 and 21.62, total 121. Are we fine here? Now let us look at an example of AFS and trading. Is it done? Let us say we purchase a share at a price of rupees 100. Dividend that we've received this year is 15. Closing value of the share is, let us say, 90. If it is classified as AFS or if it is classified as a trading security, what should be the amount we should reflect on balance sheet? AFS we will show at 90 and trading we will show at 90. How much is the income we should show on income statement? 15. On trading we will show 15 minus 10. The net value we will show is 5. This is the realized dividend. This is the unrealized loss on the stock. And how much amount we'll have to show in OCI? Minus 10. And we do not show anything in OCI. Is that okay? Please write fast. Now let us start with the next type of accounting method, which is the equity method of accounting. Now for next 10 minutes, don't write, just be focused and understand how accounting is done. Let us build a balance sheet for acquirer A. I'm going to write assets on the right hand side. Let us say they have a plant of 10,000. They have a building of 5,000. They have inventory of 5,000. And they have cash of another 10,000. Balance sheet total 20,000. 30,000. Let us put a bank loan of 10 and let's put the entire remaining amount in equity, which is 20,000. Again, balance sheet total 30. Now there's a smaller company B. Let us make a quick balance sheet for them. Let's keep their plant at 5,000. Let's put one building here for 5,000. A bank loan for 2,000. And let us have equity at 8,000. Balance sheet total 10,000. Now A has decided to purchase, let us say, 10% shares of company B. Now this 10% shares of company B, can you tell me what is the total book value of company B? 8,000, which is the value of equity. So with that book value, the price comes out to be 800. But of course we know that in the market, shares rarely trade at book value. Most of the cases they would trade at higher price. So maybe this 10% shares would cost us let's say 1,600, 2,000, 2,500. But I'm just keeping a hypothetical assumption of 800 here. In case of equity method of accounting, the entire investment into subsidiary is shown as a single line item on the balance sheet of company A. Okay, which means if this was not 800, if this was 900, that excess 100 is actually paid towards goodwill. Right? So irrespective of whether there is goodwill or there is no goodwill, on balance sheet we will always show only a single line item. Are you fine here? So how do we do accounting for this? Assuming it is 800. Now this is the consolidated balance sheet of A. They will have plant of 10,000, building 5,000. That means none of my subsidiaries assets are coming on my balance sheet. Inventory as it is 5,000. Then there would be one line item, investment in associate. And investment in associate, how much have we paid? 800. So we will have 800 here. And cash, of course, has to reduce by 800. So it becomes 4,800, 200, 9,200. And the balance sheet total, 30. On the liability side, it is exactly same. This is 20. Bank loan 10. Balance sheet total 30. Are we fine? Now, what if the market value of shares of this subsidiary increased drastically? We purchased one share, let us say, or total 10% at 800, and now the value of that stake has become 8,000. Even in that case, we completely ignore the market value of the share in case of investment in associates, because it is not an investment in financial assets anymore. Are you following this? We have invested into business model of that company. Imagine a scenario that first year this company made sales of 10,000. It made expense of 500. Sorry, 5,000. So it has a total profit of 5,000. It decided to give dividend of 1,000, and total reserves amount which is transferred to reserve is 4,000. If this associate company has made profit, the way we will account for this, so this is the income statement of A. What will happen on the income statement of A? If the profit of the associate is 5,000, we will say share of profit from associates in our income statement, and we will take 10% of that value, and we will say 500 is my profit. Are you following this? Now, if 500 is my profit, what will happen to my reserve side? Eventually, do you agree that every profit gets transferred to the reserve of the balance sheet? So, that 500 would be added here in the form of reserves. The second effect is the value of that investment in the subsidiary will also increase by that 500 amount. Is it fine? So when the associate makes profit, you take proportionate share of that profit and you show that as your profit, and you also increase the value for investment by that proportionate profit. Is it fine? In the same fashion now, if the associate has given dividend of 1,000, how much of that will you receive? 100. Now can I say this 100 is my income? It would be wrong to say that, because we have already shown 500 as income. So it would amount to double counting the same income. So when you receive dividend, you don't show that as an income. So how do you account for dividend? You reduce the value of that investment in associate by 100, and you increase cash by 100. Is that fine? So let's revise. Investment in associate we always show as a single line item. Now, irrespective of whether we paid goodwill or we haven't paid goodwill, it will always be a single line item. If the associate makes profit, we take proportionate share of that profit and we add that to our profit, and we also increase the value of investment. If the associate pays dividend, it does not go to income statement. We reduce it from investment in associate and we add it to the cash. Is that okay? And the last important point, this point was also discussed in your level 1 syllabus. Now see, what is going to happen is, imagine company A made sales of 10,000. It incurred cost of 7,000. So 3,000 profit, plus it added some investment, proportionate share of investment in associate X amount. So its final profit would be 3,000 plus X as a ratio to 10,000. Which means because of this method, the net profit margin number would always appear to be more inflated, because we are not adding sales, we are just adding the proportion of net profit. Are you fine? So write down this quickly, and I'm open to questions.
This is about associate or asset, financial investment in associate, or is it a financial asset?
Associate.
So shouldn't it be more than 20%?
Oh, yeah, yes. Now, yeah, just to save myself. Yeah, he's made a good point. Since it's financial in associate, it should be more than 20%. But the true test is not your stake. The true test is, okay, I'm just making an argument to save myself. Is significant influence. Okay, so a company A is exercising significant influence on company B at 10% stake. So this method still works. Same method, same accounting. There would be one, if the shares were purchased at 900, the accounting treatment would be same. There would be one very small adjustment, but that we will see later on. See, we have 10% of this profit we have already added to our profit. So 20% of that amount is the dividend. So we have received profit, or we have added profit of 500. Out of that 100 we have received in cash. So we don't show that 100 as an income again. We just reduce that 500 by 100 and we add 100 to the cash. This discussion. See, if your subsidiary, sorry, if the company A made sales of, let us say, 1000, it had its own expenses of 500. Okay, how much is the profit of that company? 500. But it will say plus share of profit from investment in associate, isn't it, this 500 component? So it will add that 500. Its net profit now is how much? 1000. Now net profit 1000. What is the net profit margin? Sales 1000, net profit 1000, net profit margin 100%. But how much it should have been? It should have been 50%. So what we are basically doing is we are taking the profit of subsidiary, adding that to our profit. But we are not adding sales. So your profit increases more, your sales is an increase. Your net profit margin number looks inflated. Net profit, because this is already, that amount is being taxed there. So we will add it at the bottom after the other income section. Yes. So when you want to analyze, you should remove the profit from the associate, or you should also add the proportionate sale of the subsidiary associate to your sales and then calculate net profit margin. Should we go ahead? Now the next method. Now I'll be careful with stakes. Is consolidation. And the funny thing is, you people waited for me to finish. Then you pointed out. Consolidation. Again, this is company A. Let us say this is got plant 10,000. I'm cutting down on assets now. Inventory 10,000. Cash 10,000. And let us say there is no bank loan. Equity 30. This is company A. This is a smaller company B. It has plant of 10,000. Bank loan of 5,000. Equity of 5,000. A has decided to buy 60% stake in company B. This 60% as per book value should be how much? 3,000. So in this example, let's keep it as 3,000. Now what happens? When we prepare a consolidated balance sheet A plus B using the consolidation approach, what we are going to assume that since we control the company B, their plant in a way is our plant. So now the value of your plant is going to be 20,000. Value of inventory 10,000. Value of cash 7,000. Why 7,000? 3,000 paid towards to the shareholders of company B. On the left hand side, equity 30. Now we own, so let's take a total. This is how much? 37,000. Now in this case, now we would not have investment in associates. Let me just check if I've done this right. No, equity won't be 32,000. Just a minute. Bank loan, hold on a minute. 5,000. Now we have purchased 60% stake in the company, but we have added all of their assets to our assets, all of their liability to our liability. But how about those 40% shareholders? Okay. So now the thinking is that it is my subsidiary. I am owning the 60%. So those remaining 40% are now my shareholders, but my shareholders of subsidiary company. So then those people we will call as minority interest, and minority interest would be 40% of how the business was valued, which is 2,000, and that's how your balance sheet will tally. Right? So minority interest are those people or those owners of your subsidiary which is not owned by you. Are we okay here? Now just wait for some time. Now what if I had not paid 3,000 but the payment was made 3,500? Now we paid that excess 500, correct? And that excess 500 is payment towards goodwill. So now what happens on consolidated balance sheet? Goodwill will become 500 and minority interest cash will reduce. Yes, cash will become 6,500. Yeah, in this case there wouldn't be any change on minority interest. Okay, but let's not write goodwill. Let me reduce this part. Let's keep this as 3,000. Let's keep the cash as 7,000. Now what if the subsidiary makes sales now, or what if they have profit? So let us say this is company A's income statement. They have made sales of 10,000, they have expense of 3,000, and they have net profit of 7,000. This is company B's income statement this year. Sales 1,000, expense 500, profit 500. What you would do now is prepare a consolidated income statement A plus B, and consolidated income statement would be sales 11,000, expenses 3,500, profit 7,500 minus the share of minority interest, which would be 200, which is 40% of 500, and then you will show net profit of 7,300. If you were to use equity method, how much would have been the net profit? Instead of consolidation, if you were to use equity method, how much would have been the net profit? It would have still been 7,300. Why? Because our profit 7,000 and we would have added 60% of associates profit, isn't it? So which means whether you use consolidation or use equity method, the value of net profit will always be same. But what is changing is the net profit margin now. Now on the consolidated income statement we have sales of 11. Had we used equity method, sales would have been 10,000 but net profit would have been 7,300. Is that clear? So please write this down. Are we done? Now in the same example, I will add the proportionate consolidation method. Proportionate consolidation in certain rare cases can be used in case of joint ventures. Okay, joint ventures, the recommended method is equity, but in certain cases we can also use proportionate consolidation. Now we will use the same balance sheet and see how proportionate consolidation would work. In proportionate consolidation, you will add up only the proportionate amount of assets to your balance sheet. So plant was 10,000. We have 60% stake in this plant, so your plant will now become 16,000. Cash will reduce by 3,000. So let's take a balance sheet total. 16 plus 10, 26 plus 7, that would give us 33,000. Bank loan 5, but our share is 60%, so bank loan is 3, and now we will have 33,000, which means in proportionate consolidation method we do not have minority interest. Are you fine? What happens on the income statement? Sales was 10,000, it will become 10,600. Expense was 3,000, it will become 3,300, and profit will become 7,300. So again, whether you use consolidation, proportionate consolidation or equity method, the value of profit will always be same. So then build a separate example and then write down the working for proportionate consolidation. Proportionate consolidation can be used in case of joint venture in certain restrictive circumstances.